So let me explain how we can do the stock valuations in finance. So essentially we are asking this question: how do we find the fair or the correct stock price? We have two main approaches. The first approach is known as the present value of cash flows, or discounted cash flows. So cash flows could really come in different forms. It could be in the form of free cash flow. That means this money only belongs to the shareholders. Everyone else has been taken care of. A second way we can think of the cash flow is going to be in the form of dividends, money that is going to be paid to the shareholders. A second approach to valuing stock is known as the relative valuation approach. So this approach is actually subjective. This one is going to be objective based on numbers. And the most famous approach under the relative valuation approach is going to be the price-earning ratio model. And there are other variations of it. Instead of price to earning, we could do price to cash flows. We can also do price to book value ratio model. So what is really this price to earning ratio model? So it says the stock price today denoted as P sub 0, 0 mean is the current time. We take the existing price to earning ratio. And then we multiply it by the earnings per share. So this is something that the firm is going to be reporting to the market, to the shareholder every quarter. Every time new earnings per share are going to be released, we multiply it with the P ratio of the firm. That's going to give us the stock price. Now let me go back to our first approach here. So in order to find the stock price, we can first find the firm value. So we will use the first approach here. Present value of the cash flows. So mathematically speaking, we can write it as follows. So CFs are the cash flows, and this is our cost of capital. Or WACC, something you have learned previously. So this is going to be the market value of the firm's assets. And you should know from the basic balance sheet identity of the firm that the total assets are going to be equal to equity plus debt plus the preferred stock. So from it, we can really take everything else to this side here. Equity is going to be total assets minus debt minus preferred. And once we have the total equity value from here, we can divide by the number of shares outstanding. And that is going to give us an accurate way of finding the share price, or what we call the fair stock price, or the intrinsic, meaning correct stock value. So you may wonder, well, where do these cash flows come from? Remember, these are not the actual cash flows, these are the expected cash flows. These are forecasted. So firm has to forecast its balance sheet, income statement to really estimate these ones. And these estimates could change over time as new information comes in. Cash flows are going to be changing, and that's going to lead to a different estimate of the stock price. So this is going to be fairly objective based on the actual earning. This is going to be more of a subjective estimate. And this is really the most correct way of finding the stock price. All right, let me then stop here.